Imagine waking up and 1 lakh crore has vanished from the stock market. Not because of a war, not because of a global crisis, but because of just one letter. A letter with no names, no proof, just one dangerous phrase.
12 days since the abrupt exit of Atanu Chakrabarti as the chairman of HDFC Bank.
Incongruence with my value and ethics. My value and ethics are very different from that.
And within hours, India's most trusted bank was in free fall.
It is India's second largest bank, and right now it's in the middle of a storm. Last week, its chairman walked out, and with his exit, the bank has lost $16 billion in market value.
On March 18, 2026, HDFC Bank's chairman resigned. No detailed explanation, just a cryptic statement about values and ethics. And the very next day, the stock crashed. Nearly 9% down in a single session, dragging the entire market with it. Because this wasn't just any bank. This was India's second largest lender. But here's where it gets strange. Just 24 hours later, he says there is no wrongdoing.
That in the letter that I've written, I am not pointing out to any wrongdoings at the bank. There is no malpractice that's happening at the bank. That's not what my intention is of the letter. And the only difference is in terms of where ideologies go.
Wait, what? You raised concern about ethics and now you're saying nothing is wrong? And that contradiction triggered panic. Because in the stock market, uncertainty is more dangerous than bad news.
Last week, its chairman walked out, and with his exit, the bank has lost $16 billion in market value.
Within days, the stock hit a 52-week low, rupees 75, then rupees 731. And just like that, over 1 lakh crore in value was wiped out. So the question is, what exactly is going on?
Nearly 70,000 crore of investor money has been wiped out from the HDFC Bank market capitalization.
To understand this, you need to look at 3 hidden layers. A risky financial product, a complicated merger, and a growing imbalance inside the bank. First, 81 bonds. These are not normal investments. They offer higher returns but comes with extreme risk. There is no fixed maturity. And in a crisis, your investment can be written off completely. Zero. Imagine this. Akash, an NRI, moves 1 crore into a high return product, promising 12 to 13%. It sounds safe. But when the issuing bank collapses, the money disappears. This is exactly what happened globally with such bonds. And reports suggest similar products were sold without fully explaining the risk. That's where trust starts breaking.
It's the biggest transaction in the history of India Inc. HDFC Bank has taken over its parent housing financing major HDFC. With this merger, HDFC leaps to the 4th place in the world's most valuable banks list.
Now the second layer, the merger. In 2023, HDFC Bank merged with HDFC Ltd. This made the bank bigger, but also more complex. It suddenly had a massive loan book without enough low-cost deposits, so it had to rely on expensive funding, which reduced profitability. In banking, this shows up as net interest margin, and that margin dropped significantly, from above 4% to nearly 3%. That's a big hit. Now the third layer, regulations. Banks must keep a portion of deposits locked. They cannot lend it. Earlier, this didn't apply the same way. But after the merger, a large amount of capital started sitting idle, not generating returns. And on top of that, loans are growing faster than deposits, which creates additional pressure. So when you combine everything, risky products, lower margins, structural pressure, you get one thing, a trust problem. And in banking, trust is everything. Because once confidence shakes, everything else follows. HDFC has built its reputation over decades, but moments like this test that reputation. If you found this useful, hit like and subscribe, because these are the stories that actually move the market, and most people miss them. I'll see you in the next one.